This is part 5 of a 6-part series covering the Mike Company Master Budget Project. In this part, we are going to prepare the Mike Company Proforma income statement. First, we're going to start off with the proper heading. A proforma income statement is just like a regular income statement, but the idea of proforma is it's budgeted, it's forecasted. It's not a historical income statement, but a forecasted income statement. With any income statement, we always start with sales. And of course, we've already calculated our sales from the sales budget. So we're going to link to our sales budget. Our January sales, total sales were 100,000. Let me just format these cells. In a contribution margin income statement, which is what we were preparing, we then subtract out all of our variable costs. We have two basic variable costs. The first is our cost of goods sold, and the second is our variable selling and administrative expenses. Cost of goods sold we've already calculated on our purchases budget. The cost of goods sold is 50% of sales. And our variable selling expenses we've already calculated on our selling and administrative expense budget. And in January those are 6,000. So our contribution margin is equal to our sales minus our variable costs. From there, we subtract out all of our fixed costs. Those fixed costs include our fixed selling and administrative expenses, and the other cost that we have that we know about that's an expense is interest expense. The fixed selling and administrative expenses we've already calculated on our selling and administrative expense budget. Those in January are 11,500. And our interest expense is equal to, if you recall, 1% of the beginning balance of long-term debt. So you can calculate it. It also happens to be the same amount that we pay in interest expense on our cash budget. We'll just recalculate it. It's equal to 0.01 times our beginning balance of long-term debt. We've already calculated our beginning balance of long-term debt on our cash budget. We keep that running balance of long-term debt. So if you take your contribution margin less your fixed costs, that'll give you your pre-tax net income. And that's equal to your contribution margin minus your fixed costs. Now, if you had income taxes, you would subtract out income taxes here, but in Mike Company there are no income taxes. So that gives you your net income equal to, your pre-tax income minus your income taxes. And let's just get a little subtotal here. So if you had income taxes, by the way, it would be, tell you, for example, like in Excel 3, that income taxes are, I forget if it's 20 or 25% of pre-tax net income. Income taxes are always some percentage of pre-tax net income. So We can do February and March fairly easily. We know that February's sales, go to the sales budget. Our cost of goods sold is on our inventory purchases budget. We know variable selling and administrative expenses is on our selling and administrative expense budget. The totals are the same. Oops. Fixed selling and administrative expenses are on your selling and administrative expense budget for February. Your interest expense is equal to 0.01 times the beginning balance of long-term debt on your cash budget. Pre-tax net income is the contribution margin minus your fixed costs. And your net income then is $35,426. March, the same thing. Your sales, go to your sales budget for March. Your cost of goods sold is equal to the cost of goods sold on your inventory purchases budget. Your variable selling and administrative expenses are on your selling and administrative expense budget. Your contribution margin is simply sales minus your variable costs. Your fixed selling and administrative expense budget your fixed selling administrative expenses is on your fixed selling administrative expense budget. Interest expense is equal to 0.01 times your beginning balance of long-term debt. And so, in essence, your totals here are $40,862 as your net income for March.